Hello and welcome to another Escala interview with the fund managers. My name is David Bruty and I'm an analyst in the Escala Chief Investment Office team. Joining me on the podcast today is Doug Tynan. Doug is a founder and Chief Investment Officer at GCQ Funds Management, which was founded in 2021. Good afternoon, Doug, and thanks for joining us on the podcast today.
Thank you, David. Thank you very much for having me.
Maybe if we start, Doug, on a bit of your background prior to the formation of GCQ.
Oh, thank you. If we go way back, I grew up in Brisbane, and if you ask anyone who knew me back then, they would have said I was quite an awkward teenager. And at 13 years old, I knew exactly what I wanted to do, and I was very specific about it. So it was a bit unusual. And I wanted to be an investor, and I wanted to be an investor in companies outside of Australia, some of the best companies in the world, monopolies with pricing power. I got a lot of that from coming from a wider family of stockbrokers, financial planners, and accountants. So I sought out the best investors in the world from a young age and read everything I could on Warren Buffett and Charlie Munger, and that sort of shaped my thinking of investing from an early age. And went from there, started investing in stocks when I was 13 years old.
And how did that develop into the formation of VGI, and how is that similar to what you're doing today?
Yeah, so I took the advice quite literally Charlie Munger used to give, which was understand accounting because it's the language of investing. And I studied accounting at University of Queensland, and I'm pretty sure I was the only person in my graduating year to actually put their hand up to elect to do audit. And it wasn't the most popular choice, but I loved it. And what Charlie would talk about is you got to understand accounting, the language, you got to understand debits, credits, income statement, balance sheet, cash flow. So I learned everything I possibly could about that. I really thoroughly enjoyed audit. You got to work on a lot of different types of companies, travel a lot, for-profits, not-for-profits, listed companies, big companies, small companies, governments, and just learn how they tick. Plus got to learn all the audit rules, all the audit tests. So we often use them in short selling to this day. And that was a natural progression then from accounting into what I always wanted to do, was get into investing. And joining VGI in late 2007, early 2008, we were a very small firm back then, but we grew quite steadily and successfully from great outcomes for clients over a long period of time and word of mouth into quite a large manager. And then we had great returns over the period of time I was there anyway. And we ultimately IPO'd the management firm. About a year after that, it was time for me to move on. Didn't have any plan on what I'd do, but it just naturally came back together because I love investing, and the team I worked with for a very long period of time was pushing me to set up GCQ. So we did that, but we did it with a couple of major differences, and because we learned a lot from our past mistakes. So we wanted to stay fully invested. We wanted to be a product for Australians to invest outside Australia in the best, highest quality companies in the world, monopolies and irreplaceable brand names. And we wanted to be a daily price product where we don't manage anybody's cash. So anyone invested with GCQ or a GCQF is our ETF knows that they're 100% invested in the highest quality companies at any time. So that was a natural progression to setting up GCQ. And then when we first opened to external investors, we actually raised a bit more money than we thought we would. A lot of them came from prior investors at VGI because the returns at VGI weren't so good at that time. And after we raised a bit more money than we thought we would have, David Simons, our CEO, did a recruitment drive to look for the best distribution head in Australia, and we found Stephen Higgins, who joined us and built out our distribution capabilities. So we're very proud of our distribution team and capability. And it's an incredibly important part of funds management to have a client base, an investor base who's fully informed and able to make decisions, informed decisions on whether to add to their investment, make the investment, not make the investment, or hold more cash. So it's been quite a natural progression. We just work with very good people and find the best talent and business partners.
Maybe if we expand a little bit more on your underlying investment philosophy. You are a quality fund, so how do you define quality, and how do you go about finding the businesses and industries that you do ultimately invest in?
Yes, David, that's a very good question. In fact, we put quality in our name. So GCQ, global, concentrated and quality. Now, global, we obviously invest globally outside of Australia. We don't invest in Australia. Concentrated, we concentrate our capital into our best ideas, and it ends up being about 20 companies at a time. So we're far more concentrated than a passive index fund, and that's how we outperform those index funds over time. And Q for quality is the most important word in our name, and quality is an important thing to define because everyone has a different definition of quality, I find. And your definition of quality can actually change over time. So at GCQ, we very specifically define quality through our GCQ industry quality checklists. And anyone who follows us over time knows that we're quite obsessed with checklists. We talk about checklists all the time and process, and it's just in our DNA. So when people invest with us, they're backing us to follow our process and checklist. So our simplest or first checklist, not our simplest, but our first checklist is our GCQ industry quality checklist. And that's a series of 26 questions. And it narrows down the entire world into only 20 industries and 221 companies. So that's all we look at, 221 companies, the highest quality monopolies and duopolies in the world, and irreplaceable brand names. So whether it be Visa or MasterCard, whether it be S&P and Moody's, or in luxury goods, Cartier, Hermes, Van Cleef and Arpels, or WD-40, the humble can of WD-40. They've all got pricing power, and they get through our checklist. So the key check on our checklist that we're looking for is, has the industry had any successful new competitor in the past 20 years? So there we're looking for barriers to entry. What's stopping a new competitor from coming into that industry? So that's really our philosophy, investing in monopolies, investing in companies with no competition, or our favourite is where there are two and they pretend to compete, but they don't really compete, like a Visa or a MasterCard or an S&P and a Moody's. They're just wonderful businesses. And then adding to that, we just don't like leverage either. We don't like debt. So our companies generate significant amounts of cash flow and they don't have debt. And that really helps in the down markets. And it's why we outperform. It's one of the key reasons we really outperform in down markets as well.
And you did touch on the concentrated aspect. So you do have around 20 holdings at any given time. And
Yes.
These holdings fit into approximately 7 to 10 diverse industries. Talk to how you settled on this number of stocks for your portfolio's construction.
Yeah, that's good. So in portfolio construction, we pick the industry first. So we're not there picking stocks first. We're picking the industry. We pick the industry that we want to invest in. Like it might be super luxury goods. And then we want to invest up to 15% in that industry. And we're allowed to grow that industry up to 20%. But no industry can be more than 20%. And the reason is diversification. So we get the benefits of concentration with around about 20 companies. And we also get the benefits of diversification as well. And if you look at our returns over time, they're typically, we get outperformance with less volatility. And that's what we're looking for. So we want some diversification, but not too much. Statistically, when you go up to 40 companies, you start getting much closer to the market's return, no matter how good you are at picking stocks. So we just feel that anywhere around about 20 is roughly right. It allows us to invest in a wide selection of industries, very high quality industries, different countries. So if you look at our attribution, how we made money over time, we're very proud of looking back at our attribution because even though we've got nice returns and compounded at 30% per annum for the past 3 years, well ahead of market, the attribution of those returns, it's been very broad based. It hasn't just been one or two companies or flavour of the month companies or NVIDIA or Tesla. Whenever you see a manager that their returns are being driven by the fastest growing companies, and there's only a couple of them in the world, you've got to watch out because that might not be repeatable next year. So when you look at our attribution, which we produce on a regular basis in our letters, you can see that it's very broad based across market cap. We've got some multi-trillion dollar companies. We've got some couple of billion dollar companies across geography, across industry, across how they make money. But they all have one thing in common. They've all got extreme pricing power.
And another aspect of your fund is that you do incorporate short selling of companies on an opportunistic basis. And this is something in which you did have some success with at VGI Partners in the past. So can you maybe explain the reasons why you do include it as part of the strategy at GCQ, even though it might be more limited in nature?
Yeah, sure. Well, it is limited in nature. I tell people to think of us as predominantly long only. That's how we make the vast majority of our returns. So on our 30% compound over the past 3 years, vast majority of that has been from the long portfolio, almost all of it. Now, we do make some money out of shorts. It's not material compared to the 30%, but it is material compared to our management fee. So internally, it's nice to try and cover some of the management fee with short proceeds. So we do make money short selling. What we typically like to short sell is we call frauds and fads. So frauds, obviously accounting frauds and overstated earnings, and fads, think of Crocs shoes 20 years ago, or Krispy Kreme, or Prime Energy drink recently. We've got one short on the moment on the fad category, the Labubu dolls. So it's made by Pop Mart, and we only put it on recently, and I actually love the product. I think they're fantastic and great marketing idea. But it's definitely a fad in our checklist because you've got unlimited supply as the demand's growing. So whereas luxury goods or nice handmade watches, you don't have unlimited supply, or Hermes Birkin bags, there's no unlimited supply. So the fad's definition is when there's unlimited supply as demand's growing. And then they always come back down the other side of the mountain very quickly. So we've got a nice short on that at the moment. That's our biggest short. We put it on at $300 and we're already in the green there by quite a way. I think it's got quite a way to go down as well. It was the biggest toy company in the world a couple of months ago. That's always a bit of a red flag too. And then on the fraud side, we're short significantly overstated accounting. And we're often short companies in Australia because we've got a competitive advantage in Australia. And I remember, I'll go back to that audit experience I talked about initially. We've got 120 different short screens that we look for. And a lot of them are accounting based. But there's a few qualitative ones as well, like where the CFO lives, where the CEO, CFO live. Doesn't mean anything on its own. And I love the Gold Coast. Go up there all the time from Queensland. We've got a place on the Gold Coast, but most of Australia's accounting anomalies have come from management teams that have been pretty close to the Gold Coast or Brisbane. So in the US, it's Miami. So thinking about all these things makes you a more skeptical investor. So I like that the whole team spends a small portion of their time, maybe only 5%, but we're looking for shorts and we're looking for these frauds and fads. And it makes you a better investor on the long side too, because we also put all of the wonderful businesses that we own through our own short checklists, and it'll if anything sticks out, we're going to see it. So I think it makes you a more skeptical investor. There's some very good investors I know and friends of mine in Australia. They've fallen for some of these long onlys. They've fallen for some of whether it be Slater and Gordon or Blue Sky in Brisbane or ABC back in the day. And they're very good investors, but because they're not looking at it from the lens of this might actually be made up. So, yeah, we look at it from that aspect, and it makes us a better long investor, we feel.
And as you noted, the businesses that you seek out are in industries that have monopoly, duopoly, or oligopoly characteristics. So I was wondering if you think this is becoming a bit more challenging to identify these in today's world, whereby technology is evolving quickly and potentially disrupting well-established business models more quickly than what we might have seen in the past.
Absolutely it is. So the part of our process, once it gets through our checklist, our first industry checklist, then we're confident that it's got a barrier to entry because it's had no successful new competitor in the past 20 years. So we're confident it's got a barrier to entry, but it's not good enough just to know that it has a barrier to entry. You've got to know what the barrier to entry is. And we particularly like industries where people have tried, like Apple's tried to get into payments with Apple Pay and tried to compete against Visa and MasterCard, but it couldn't. So it actually partnered up with them because it just couldn't compete with them. So every Apple Pay transaction actually ends up going over Visa, MasterCard or American Express. So we want to know what is causing the barrier to entry. And we've identified in our process 8 different barriers to entry, 8 different reasons for a monopoly. Now, the 8th one, we rank them 1 to 8, 8th being, 1 being the best, 8 being the worst. The 8th one is a technological advantage. Now, if you're in an industry or a company with a technological advantage, we're not going to invest in that. The reason is, in the history of the universe, there has been no company or industry that has maintained a technological advantage. So, Dave, to your point, technology, things are changing all the time. We're not interested in that change. NVIDIA might be an example of that at the moment. Intel was the winner 15 years ago, Cisco before that. We've got no idea who the winner is going to be in 15 years' time. I'm not saying it won't be NVIDIA, I just don't know. Or Tesla's a great example as well. It's got new competitors coming in all the time. So that doesn't get through our checklist. So if you've got a technological advantage, that's the worst one. Now, if we go to the best one, it's a network effect advantage. So we want to understand why has Visa and MasterCard had no successful new competitor since 1966? Technologies have come up. I mean, you can pay on my watch now. The first credit card was a piece of paper and the restaurant had to phone up the bank and you might get the money 3 weeks later. So absolutely the technology's changed, but the back-end network hasn't changed. And what I mean by that network is we're looking for network effects. So the simplest form of a network effect was the telephone. Picture in 1906, I'm the only person in the world with the telephone. It's completely useless. I can't call anybody. And then, David, you get a telephone, and then it's valuable. I can call you, we can chat, and then you'll get sick of talking to me. So and another friend, someone else gets a telephone. The more people who get added to the telephone network, the more valuable that network is for everybody on the network. So that's what we mean by network effect, and it creates lock-in. And Visa and MasterCard have that. They're a network between all the banks in the world, and everyone carries a Visa or MasterCard branded product, or it's on their watch or wherever, or on their phone. And the reason they do is they know that it's going to be accepted everywhere safely, securely, 24 hours a day, and it won't be rejected. Now, it's impossible for anyone to come up with a new one because you'd need all the banks signed up day one, and then you'd need all the card holders that same day. It's just chicken and the egg. Or Uber's an excellent network effect. It's probably one of the best we've ever seen, where everyone's, if you want to get a ride somewhere, you're probably going to use the Uber network because you know it's got the most drivers and it's got the most options and you're going to get the quickest car turn up. And if you want to be a driver, you're going to want to drive for Uber because you know it's got the most customers. Now, that's a wonderful network effect because it's in 15,000 different cities around the world. So just because you win Brisbane does not mean you're going to win Sydney. So that's a wonderful network. So we're really looking for why the company is a monopoly. If it's a monopoly because of technology, that'll change all the time. So we'll stay away from that. If it's a monopoly because of a network effect, that's a very strong lock-in. Then we'll monitor the health of that network over time. And not all networks are built the same.
Before we look at some of the stocks and sectors represented in your portfolio, I think it'd be worthwhile touching on two of the big drivers of equity markets over the course of this year, being US trade policy and then the broader artificial intelligence thematic. Have the developments with respect to US trade policy impacted any stocks in your portfolio, and how did the portfolio perform through that initial Liberation Day drawdown in markets that we did see in April? And then secondly, what is your exposure to the AI thematic in your portfolio?
Okay, so first on trade and tariffs, it's no coincidence that we weren't materially impacted at all because it's in our checklist and it has been for a long time. It's not something new. We're always worried about geopolitical risk and tariff risk, or stroke of a pen risk, we call it. So in our portfolio, the only companies that manufactured anything were actually Cartier, Van Cleef & Arpels, and MS, and WD-40. So we've got three luxury goods, and they manufacture everything. The luxury goods, we're manufacturing everything in majority in France. And yes, they do sell into the US. It's not a huge market for them yet, but it's growing. It's a very important market. Now, on tariffs on luxury goods, we weren't worried at all because, firstly, the tariffs on the COGS, cost of goods, which is much lower on luxury goods because they're just buying commodities like gold and diamond and they mark them up. And then you're buying a lovely Cartier bracelet or a nice Van Cleef & Arpels brooch. And so there's a huge margin on it. So the actual tariff impact's very little. And the other thing is they're Veblen goods. So in economic terms, they're Veblen goods, which means as the price goes up, demand for the product goes up. So the French were sort of laughing at it and just increasing the prices, or the price of a Birkin bag just went up in the United States. And the demand didn't soften whatsoever. In fact, ultimately it got stronger. On WD-40, every can of WD-40 sold in the United States is manufactured in the United States. So that really is a poster child for the Trump tariff ambitions. So that was very good too. But it wasn't a coincidence. It was because of our checklist. So we didn't get impacted. We did own some Ferrari, which obviously manufactured in Italy. And with the global, there was an announcement of the global car tariff imports of 25%. Well, Ferrari just came out the day after that and said they'll just increase the price of the car by 25%. And they sold them all anyway. So these are things we think about. We won't invest in something that has any material geopolitical risk, or that we can see any material geopolitical risk. So as a consequence of that, in the past 12 months, our returns are up about 22, 23%. And that's without owning the biggest performers in the market. So it's very broad-based returns. We don't own NVIDIA, we don't own Tesla because they don't get through our checklists. Now, please don't read into that you're going to run out and sell Tesla or NVIDIA. I'm not saying that. All I'm saying is it just doesn't get through our checklist. And they've done phenomenally well. So without owning those companies, we've been able to still generate very good returns. And And it all comes back to our checklists and our processes. Now, returns during that period, we were down, because in any sell-off, we're going 100% invested, but we were down about half of what the market was down, and then we bounced back very quickly. And we've got a saying at GCQ, we own tennis balls, not eggs, because tennis balls bounce. So, yeah, that was our experience through that. We stuck to our checklist. There were a few scary days there in markets, particularly in the bond market started rolling over after that weekend. But in investing, it's very tempting all the time to move away from your processes. But our processes and our checklists simply don't allow that. So you've seen managers over the years, and it's usually in a big market event like a pandemic or a GFC, where no one's seen it in 100 years, no one around has seen it. They're very scary times. It's very uncertain what's going to happen, and it's very easy to not stick to your disciplines. And you've seen plenty of managers ruin great track records because of that. And I think we would do the same if we didn't have our checklists and our disciplines. So now on AI in our portfolio, we've had a lot of positive exposure to it. It's obviously AI has been helping drive markets. It's helped drive our investment in Meta, Facebook was a big position, Google too, now Microsoft we've owned in the past. So a lot of the share price increase on those companies in the last 12 months can be put down to optimism around artificial intelligence. So we've benefited from that significantly. We're actually currently cutting those positions down a little bit just because they're getting closer to what we think fair value is, or the margin of safety is shrinking, and we're able to invest in other companies. So we're not trying to pick the next winner of AI. I don't think that's possible. I think that's fraught with danger. We're owning companies that are generating significant cash flows out of their current businesses, and AI is helping them as well. They're helping them find efficiencies. But we're not going to try and find the next AI winner, but ensure that we don't own an AI loser, as we call them. So we don't want to own a business that can be disrupted by AI. So that comes back to the barriers to entry and making sure that we understand our barriers to entry, and they're not technological barriers to entry, that they're more like property or network effect barriers to entry. So we certainly respect AI. We use it in our processes all the time. We think it's fantastic, but we're not going to try and pick the new technology. We can only invest in industries and companies that generate significant cash flow today.
Let's turn to some stock examples. And the first one I want to ask about was Alphabet, the parent company of Google, which is an incredible monopoly-like company that has only emerged in the last 3 decades or so. The progress in consumer take-up of chatbots like ChatGPT has been pretty extraordinary just in the last 3 years. And at the same time, they've potentially threatened Google's dominance for search as more and more user queries are generated by chatbots instead of Google search. How do you view this disruption unfolding? And secondly, what is the investment case for Alphabet at the moment?
Yeah, I think that's a very timely question. So my personal view is Alphabet's the riskiest stock that we own today. Now, if we talk about maybe 3 years ago, even it was our biggest position. And the reason it was our biggest position is I could comfortably say that it had no successful new competitor in the past 20 years. It's got 97% market share of search. And the reason it's got 97% market share of search is because it gives you the best answer, so everyone goes there. And it gives you the best answer because everyone goes there. So it learns on itself. And we even had a case study. Microsoft set up Bing probably 12, 13 years ago, spent tens and tens of billions of dollars on it. I'm sure they put some very smart people on the job, but they only got 3% market share of search after all that money. And of the 3% market share, it would have been very frustrating to them to learn that half of the 3% was actually people searching or binging for the word Google or YouTube, which is YouTube's and obviously an asset that's owned by Alphabet. So that must have been very frustrating for them. And it was nothing to do with the management teams. You could have swapped the management teams, you would have got the same outcome. It was to do with the industry structure. So Google was an absolute monopoly. ChatGPT came out. Now, when new products like a ChatGPT come out, they're often considered toys initially before they're taken on really mainstream. Just like the automobile when it came out. I think the stat was it was less than 1% of people in the world were going to be capable of driving. And obviously maybe that's still true, but a lot more people drive. So they're seen as toys before they really take mainstream. So we were very wary of ChatGPT. We're obviously looking at market shares. We can see who goes to every single search product in the world every day. We're looking at it basically on a daily basis. I was looking at it on a weekly basis. And we saw that market shares weren't shifting, yet we could buy Google at $90 to $100 a share. It was on about 8 times free cash flow. So that was an incredible buying opportunity. We made it our biggest position. Then it went up to over $200 a share, and we cut it down significantly. We didn't get the top, but we cut it down significantly. Then ChatGPT actually started becoming popular, like not being the toy anymore and starting to be the far more mainstream, and it's growing extraordinarily quickly. Now, I think it is disruption. So far, it hasn't happened because Google hasn't lost its advertising revenue. And the reason is people still use Google to search for goods and services that they want to purchase. And they don't use ChatGPT for that yet. But I can't see a world where that won't change at some point in the future. I think Google will still be extremely dominant in search, but it's going from being a monopoly to something else. There's going to be plenty of other competition. There's going to be other competition there, which I think it just means it's not as good as it used to be, and we're not as sure about it as we used to be. And as a consequence, as the share price has gone up, it's now at its all-time high share price. We've cut that position back significantly. We're back to less than 2% of our portfolio in Alphabet, and it might even go to zero soon. So as a consequence of the share price going up, margin of safety declining, and also I'm not as certain as I was 2 years ago that it's going to be a monopoly in 5 years' time. In fact, I'd be shocked if ChatGPT didn't start advertising and didn't start taking some of that advertising revenue. Now, we're very heightened awareness of disruption because it's what we look for all the time in our wonderful monopolies. And we've got quite an extreme check or question on our checklist, which is looking for the Kodak moment or the Yellow Pages moment. And, it happens slowly, then it happens really quickly. And that's alarmist sort of examples, but we're always on the lookout for them. So I think maybe we've started selling Google a little bit too early, time will tell, but we're very happy to take that profit and reinvest it in some other wonderful monopolies that don't have the clouds of concern about disruption hanging over them.
If we turn to another industry in your portfolio, which is well represented being super luxury goods, I think it's the largest industry group at the moment. What are the characteristics of these companies that you like, and how do you differentiate between the leading super luxury good companies that are listed in the world?
Yeah, excellent. So we rank them all. So we go to these luxury conferences and they're fantastic because they're always in Paris and Milan in summertime and everyone puts their hands up to go. Now, on our team. So we go to them and 60 companies turn up. So we've got our own checklist to rank them, and it's a very simple checklist. First question is, has the luxury brand, been around for 100 plus years? Because there's no new super luxury. You've got to be an established, very long-term brand. And that's an incredible barrier to entry because you can't just create 100 years of heritage overnight. So 100 plus years has been around. Do they manufacture everything by hand in Italy, France, or Switzerland? That's an important one because everyone buys European luxuries. Even Hermes tried to start a Chinese luxury brand and it failed. They closed it down. So everyone loved European super luxury. Now, when you walk into one of their boutiques, you'll never see a discount. You'll never see super luxury on discount. If something discounts, it's no longer super luxury because what you do when you discount is you annoy the person who paid full price last week, and you also teach all your customers into always buying on a discount. So the other thing is when you walk into one of the boutiques, we particularly like the jewelry brands like Cartier and Van Cleef, you're never going to see a price tag on anything. So that's a check on our checklist too. We go in, if there's a price tag on it, it's not luxury. Plus, it's also not fashion. We're never going to pick a fashion cycle. Designers have to decide what everyone's going to want to like in 12 to 18 months and come up with it. And if they miss that or they lose a designer, they're in trouble. So we pick the timeless luxury, like hard jewelry, watches, Cartier necklaces, bracelets, Van Cleef and Arpels, and handbags like Hermes and Louis Vuitton and Dior. So they're all timeless, and we like the dynamic, the supply and demand dynamic, because particularly with that jewelry, Cartier, Van Cleef, and also Hermes, it's very scarce, the supply, so you can't increase the supply significantly. And for everyone who's lucky enough, fortunate enough to be customer of Van Cleef and Arpels, well, there's probably about 1 million people who'd like to be. So that supply-demand imbalance is excellent, and that drives the ability for pricing power. Plus, also, if I look at the macro, wealthy are getting wealthier everywhere in the world. I'm not saying it's right or wrong. I'm just saying it's a fact. Asset prices are going up. Wealthy are getting wealthier. There's new millionaires and billionaires in the world every month, probably every day. And not everyone does, but a lot of them like buying super luxury goods. And as we say, there's only really 4 brands of global luxury jewelry in the world, and that's Cartier, Tiffany, Van Cleef & Arpels, and Bulgari. And if you had a look 50 years ago, it was the exact same 4 brands. And I'm willing to bet in 50 years' time, it's probably going to be the exact 4 brands. So just a couple of high-level reasons why we like super luxury.
And a newer industry which you've introduced to the portfolio has been the sharing economy. I think an interesting investment that you've got there is Uber. What attracted you to Uber in this industry, and how do you see the landscape evolving over the next several years as autonomous vehicles and robotaxis grow in popularity? Do you see Tesla robotaxis, for instance, joining the Uber platform, and how does the rollout of Waymo, for instance, impact a company like Uber?
Yeah, absolutely. So firstly, autonomous vehicles are the future. They absolutely will be. We're attracted to Uber because of its network effects that I described earlier. Everyone will go to the network. The rider will go to the network with the most drivers, and the driver will choose the network with the most riders. And it's wonderful because it's 15,000 different local network effects. And when Uber got out of any major hub where they were number 2, not number 1, they started becoming very profitable. And that's what we liked about it. So it got through our checklist. Now, you've got autonomous vehicles coming as well, and it's an amazing opportunity for Uber. I think generations in the future won't get car licenses typically, and they don't need to buy cars. The cars are expensive, and you've got to pay for parking and insurance and registration and things like that, when you could get an autonomous vehicle for probably a third of the price of, say, an Uber. So I think autonomous vehicles are absolutely the future. Uber owns the network. Tesla absolutely has set up its own network, but it just won't succeed until it goes on the Uber network. And the reason it won't succeed, it's only 3, maybe 4% of cars, new cars in the United States. And if you assume half of the people, which I think is a very generous assumption, but just say you assumed half of Tesla owners would allow it to go out and drive around by itself and with strangers doing God knows what in it, and then come back to pick them up. I don't think it would be half, but just assume it is half. That's only 2% of the cars, right? Whereas the rider wants to go to the app with all of the cars. So why wouldn't a Tesla owner only just put it on a Tesla app? You'd put it on the Uber app. And the great example is McDonald's with Uber Eats. When McDonald's wanted to do delivery, it could have done it itself. It could have done its own app. It chose not to. It chose the smart thing. It went straight to Uber Eats, and that's where it is. And Domino's had its own app. It was a great app. The CEO, Don, was very proud of its app, and I think he was the first person to talk about AI in Australia too. He was very proud of that. But ultimately, the network with the most people wins. And so Domino's had to go onto Uber, and that's where all the orders come from today. So I think Tesla will do the same, and it seems pretty obvious to us. But they don't need to either. Uber's actually signing up almost every week. There's a different robotaxi in the world to Uber. Waymo's signed up to Uber in a number of states outside of California. So I think they will eventually sign up to Uber. But there's a huge amount of competition in robotaxis. I wouldn't want to pick who the winner there is going to be. It might be Tesla, but it might not be. There's BYD, there's heaps of new ones coming out. So it's certainly not a monopoly, and it's not going to be a very good industry for investors.
Thanks, Doug. On that note, we might leave it there today. So thanks for your time today in introducing the fund, and we hope to see you again soon.
Thank you, David. Thank you for having me. Appreciate it.
Thank you for listening to Escala Partners Perspectives podcast. Be sure to subscribe to this podcast on iTunes. Escala Partners is a corporate authorized representative of Escala Wealth Management, which holds its own AFSL. This podcast has been prepared without consideration of specific client investment objectives, financial situation, or needs, and is for general information purposes only. Please don't rely on it for the purpose of making an investment decision. You should seek independent financial and taxation advice prior to making any investment decisions in relation to any of the content considered in the podcast, and consider any relevant disclosure documents. If you require any further information regarding the matters discussed on the podcast, please contact Escala Partners.